Here we go. Don asks, is there a sweet spot long put strike percentage above the stock price that works best for a married put? It seems like it depends on the IV and the market trend. It's more the IV than the market trend, Donald, but that's very similar. What are we talking about? Here's our married put results here. We're just going to take a look at Hess. Oh, no, I want to go sorted by EPSG. I apologize. There we go. And Hess is not on here. Of course it's not. So let's stick with Ashland. Ashland was one I was considering. It has kept moving up in price this week. That's good. Stock's at 108. And we could buy a January 110, which is only 1% in the money with a 9% risk. Okay, now I want to see something here. Good. This is perfect. The implied volatility is only 0.29. What I always do, even though this is the one that came up on the results done, I'm going to go ahead and go to the search by symbol for Ashland for the January expiration. No volume, of course, today, so that makes it a little bit rougher. And this is why I'm going here. This one to me is too high of a risk. As you know, Don, that's just the default search. You've heard me say before that when I run the married put search, I make a few changes from the default results by earnings per share growth. What do I change? Well, the stock price limit is up to 200. My account size dictates that I shouldn't really be going above $90 or $95. I'm pushing it on Ashland right now because I only have one married put open. I'm going to open two soon. Maybe Ashland and then Funko again. Funko fell out of bed. I should have gone into it 1740. It came back up to 1890, almost 19. So I'm considering that one as my lower priced one, this one, and then another dividend paying one further down the line. In any case, the two things I adjust are the underlying stock price in the search to put it down to less than 80, less than 95 or so. And I put the risk to be less than 7.5. I have no statistics to show that that works better. That's just my personal risk threshold. I don't typically like to risk 8, 8.5, or 9%. The cap is 9% on the default search, or 9.2%. I don't want to take that much risk personally. I don't have statistics that works better or worse. In general, to me, this is lower volatility, as you can see, 0.2859. We talked about the three bears last week. These would probably be my three bears. 9% is okay. If I get midpoint or a little bit better, maybe I can drop that down to a better price. 8.7, 8.6, maybe done. But here, this is a good risk. 6.6% only being 5% in the money. This one is good too, 5.5% being 10% in the money. So let me write that down. 5.7% ITM is a 6.6% risk on Ashland and 10.3% for 5.5. In this case, the first three strikes in the money, and yes, this is just really at the money, but the first three strikes in the money, we talked about the three bears. I would typically personally go with the middle one. Usually, it's only 5.7% in the money at 6.6%. Now, let's clear that up. Let's go back to the search. And I want the one that's double. I think I saw one here. Close, close. That's the closest one. Different. Let's use super microcomputer. Okay, so we are looking at something with a IV of 0.291. I was hoping for 0.55 or 0.58, but we're close here with Calares, 0.53. And stocks at 29.63, 35, a risk of 7.7%, but we have to go 18% in the money. And that's because the implied volatility is almost double of what we're seeing on Ashland. That's what affects the range in the money. And let's see here. So what's the other one I was looking at? Super microcomputer, 0.5217. We're 11% in the money for 9.2%. Let's compare that. Let's go to our search by symbol. And this is a November, not a January. So there's also the time value issue too. Oh, geez. It only offers 5-point strikes. And it's at 55 strike to get a 9.2 risk. And that's 11.2% ITM. This is too deep in the money, but that's the risk I want. I'm not going 20% in the money. I mean, if I had an expectation that the stock was going to grow 20% within the next 40 to 50 days, I'm probably just putting a lot of calls into it and taking a chance with 1 or 2% of my portfolio rather than doing the married put structure. Yes, it has a similar risk reward profile, I understand. But this risk to me is just too high, and it's because of that volatility. I would say that if your volatility is up around 0.5, you're probably going to be 17 to 18% in the money to get the 7.5% risk that you want. Now, one screenshot does not the market make, but you can kind of see here what I'm referring to. These lower IVs of 0.29. Yeah, this one's 11% in the money on GPK, and it has a 4.8% risk. Half of the risk we were looking at Ashland at only 1% in the money. But this is kind of what we're expecting. If you're in this range of around maybe 0.25 to maybe 0.3, I'd expect going 5 or 6% in the money is going to give you the 6.5% risk range, maybe up to 7. If you're between 0.3 to maybe 0.35, let's see, where's my 0.3? Here it is, 0.3 to 0.35. You're probably going to want to be maybe 11 or 12% in the money to get a risk around under 7.5%. And if you get up into the 0.4 to 0.45 range, yeah, you're going to be closer to 14, 15% in the money to see a risk at around 6%. We can run some scenarios with that basically, very quickly actually. But I'm going to do that later on for you, Don. I'm going to run some of those numbers using the Black-Scholes pricing model and the graphs here, because we'd have to bounce back and forth between 3 screens. But those numbers I gave you, I think, are going to be pretty close. So things here, oh, here's 0.25. It's right at the money with a 9% risk. Let's look at AstraZeneca. Which option would I probably choose if I was opening AstraZeneca? I bet you I can go with this implied volatility of 0.25, assuming all the ones around that for the 2023 April expiration. That's why it's 9%. I apologize. But still, I think I should be able to go 5 or 6% in the money to have a 5 or 6% risk, even in this time frame. 7.6% in the money, 5.8% risk. 3.9%, 7.2. Because it's 329 days out in time, I'm comfortable with this personally. Just going 3.9% in the money to the 70 strike with the stock at 67 for almost a year, having a risk of 7.2%. Yes, this one's not bad either. It's only about 7.5% in the money with a 5.8% risk, and we're going to get a 2% dividend or close to that 2% dividend to cut the risk down as well. So that's tempting. That is tempting. I would still probably go with the 3 bears here, the first 3 that are in the money. I could start probably selling calls right away on this one or doing income methods right away on this one, since it's only 3.9% in the money there, only 3.9% away from the stock price, Don. I think that's a good way to go. Okay, so that's on the married put structure and some of the IVs that we talked about there, what it's related to. I will get more on that for you, Don, with some better graphics, just using the Black-Scholes pricing model and what ranges you might expect with the volatility. We're going to focus on different months too. So we're going to go the minimum 160, 150 days out, the preferred maybe 220 to 240, and then just a leap, maybe 330 days out in time that we saw with that April selection there of the stocks that have it, to see what expectation you'd have to be range in the money to get the risk that you want. Okay? And that'll be probably a blueprint owners only discussion, but maybe not. We'll see. All right. For Kenneth. Kenneth sent an email question. We're going to go back to covered calls and naked puts. And we saw some of this already, Kenneth, in the discussion we had for Don about the married put structure, the married put risk, and more. And what Kenneth is asking is, can you review implied volatility as it relates to selling cash secured naked puts and covered calls? Okay, so here's what I'm going to do. We're going to isolate something very simple. This is not the search we want. We're just going to use the monthly picks of the day, Kenneth, for the covered call screen first. And I'm going to narrow this down a little bit. We're going to go no more. We're going to stay in a range of, it looks like 11 to 15% in the money. 10% in the money, but we're going to go 11 to 15. I want to try to narrow this list down a little bit and show you expectations. Okay, so the lowest return here, okay, here, let's look at this one. It's 12% in the money. It's a 1.3% return if assigned. It's tech resources, 4321. I'm in married puts. No, I'm in covered calls. I'm sorry, selling the June 38 in the money call. That's 12% in the money, an IV of 0.55, and you have a 1.3% return. Up at the top, we have Xterra Technologies. I don't know this one. It's a lower priced 1460. And it's in the money by 14%, but with an IV of 0.9403, it has a return of 3.7%, almost 3 times Tech Resources, with almost, not quite, but close to double the implied volatility. A better comparison here might be looking at, where's Apache? I just saw it. Apache here at 47.26, it's 11.8% in the money, 0.6162, excuse me, implied volatility, with a return of 1.8%, 1.5 higher, or 0.5%, excuse me, higher than the similar stock, 43.21 to 47.62, similar range in the money, 11.8 to 12% in the money here. We have a 0.5% higher because the implied volatility is roughly 0.06 higher in those cases. Where am I going with this? You'd see the same thing on the naked put screen, Kenneth. Where I'm going with this is naturally what we all expect to see. Higher implied volatility means higher premiums for like positions. What do I mean by like positions? Like positions, similar range in the money, see almost double or triple the return with a higher implied volatility. So moving up from, we're sorting by highest percentage return, but you could argue that I'm sorting by highest volatility as well, close to it. Because from 0.4933, we're just increasing mostly all the way up the ladder here to 0.9403. And the returns do the same thing, from 1.1 up to 3.7%. How does it come into play? Implied volatility is a double-edged sword. We're talking about covered call positions here, or cash-secured naked puts, that are a directional trade. These are in the money. We're giving ourselves some good protection with still the potential to make 1.5%, 2% return for 21 days out in time, or 3% return with a higher implied volatility. What do I want the stock to do? I want the stock to stay the same or move up in price, or not drop more than the range of the current stock price of break even. In this case, it's a little bit more. The break even is about 14% down, 6 points down or so on a $47 stock. More volatile positions, stocks with options that have a higher implied volatility, is likely due to some event coming up, whether it be earnings, whether it be a phase 2 or phase 3 drug trial in a biotech, which would cause the stock to swing wildly, or it could be because of recent activities of recently missed earnings, poor earnings results, or things of that nature. There's a balance. When we were in the strong raging bull market, from, March 26, 2020 to say August 10th of 2020, where you could almost go no wrong with a covered call, a cash secured naked put, or any bullish structure. Selling into the higher implied volatility was extremely lucrative for most people. In uncertain markets, these are the stocks that are going to swing more wildly. In other words, if we wake up on Tuesday after our Memorial Day festivities and we check the market at 9:30 or at 9 o'clock and we see that the futures are down 2%, 3%, or 4%, the stocks that have the higher implied volatility, you're going to see these are the ones that are going to drop more. They're going to be dropping 6%, 7%, or 8%. They're the high flyers. They have this high implied volatility for a reason, and it's because they're more volatile positions. And there's that Scorpio tankers we looked at a couple weeks ago. Okay, so to continue this discussion, Kenneth, is it important? Yes. It's important because implied volatility does give you, higher implied volatility, will give you higher returns of assigns, or with the naked puts, higher percent naked yields, comparing similar stocks, similar ranges in the money or out of the money, depending on what you're looking for. You're getting more bang for the buck. But it also comes with the issue that these are the stocks that have a bigger tendency to swing against you. This one's been strong and moving up, but I think it has earnings coming up between now and expiration. I'm not clear. 7 days ago, last week, we talked about it when it was at Yeah, it was $29.80 or $30 when we looked at it, when it came up on the, it was a covered call or naked put screen. I think it was a covered call screen. I mean, this has a MACD that I like, and this, I'm still tempted on this one as a married put or standard collar position. In any case, not a direct recommendation or suggestion, just me musing here. I also like Apache. We talked about that last week for married put as well. Oxy's a good one too for married put, perhaps. Anyway, but those are the positions you want to worry about. Let's look at the highest one, Xterra. Yeah, you can see why. This has had some wild swings. I know it's only from $13 down to $10.25 in about a 15 to 20 day period, but then it's all the way back up to $14.50. This thing has had some weird moves. I'd want to know why this happened. Was that earnings related? Was it something else? Was it just the general market conditions? What was this one? This is a pretty big movement, 1150 up to 1275. Why? Why was that? In these last 2 days, was this earnings related? Yeah, I can pull that up on the chart. But I mean, that's the research, Kenneth, I have to go into. Even if it's the highest return because it has the highest implied volatility, I'm not jumping right into this position personally. I'm doing more research and analysis. And if I don't like that chart because of wild swings, I'm just going to move on to the next one, which is still a pretty good return. But again, it's another $12 stocks. And you've got Bumble, which has been all over the place as well. One thing to limit the risk of seeing too high implied volatility positions. If you're sorting by return, the highest return, you're going to see volatile positions, might be biotechs, might be other things, if you don't have other criteria for the stock. You want to know what sort of the mean is of implied volatility for the options. And the way we can do that is we just go to Learning Center, on PowerOptions. Let's go to Market Activity. And I want to go to Optionable Stock Statistics. This gives me a rundown of various things such as delta, volume, different prices, SMA 20s, and of course, as we mentioned, implied volatility. So right now, the average implied volatility, or the mean implied volatility, I should say, across all optionable stocks, indexes, and ETFs, every strike, every expiration, the average implied volatility right now is 1.05. Okay, so normally, what I like to do is cap my implied volatility to be a little bit below that. I might go to maybe 0.8 or 0.75 in this case. I'm sorry, I went to the wrong screen. I want to go back to our, oh, no. Yeah, I did want to go there. I'm sorry. I want to go back to our covered call search. All right. So I'm going to limit the implied volatility to be maybe less than, let's just use 0.75. I like that number. It's about 25% down from the mean there. I want to be more controlled. I want to look for more controlled positions that aren't as volatile. But what I also don't want to do is see stuff maybe that's at 0.2 or 0.3 that's too low of an implied volatility. But honestly, that probably wouldn't match my minimum return or downside protection with that low of a premium. But yeah, we're going to keep that in there anyway, 0.2 or maybe 0.25. I don't want to be too far below the mean either. It's still, a fair amount of results here, but still within the range of what I took all the 3% ones off. But I'm still going to research and analyze each one of these positions further before opening it to see what it is. But that view there, when you go to Learning Center and the market activity, then optional stock statistics, you can see the average implied volatility, average beta, that's kind of low, I think, 0.37. The average earnings per share growth across the entire market right now. You've got other things, the put call volume ratio, the high and low, and everything along those lines. So usually I only look at this for implied volatility, or maybe the 20-day or 50-day volatility as well in those cases. For the underlying stocks, the implied volatility is just for the options. The SIV is the average implied volatility of near-term options. That's much higher near-term, and we, of course, know why. All right. So that's just a way you can look at it to get a gauge when you're considering a potential criteria to use, things of that nature. But really, the only time I use this for implied volatility, 20-day and 50-day volatility, to look at the means there for those different ones. And that'll help you maybe set up a search screen there as well. So, Don, that's the Kenneth, I'm sorry. Kenneth, that's the best way I can answer the question. Also, in relation to Kenneth's question, when he first sent in the email, I told him to check out the playlist. We have the full playlists here for volatility. Did I just skip over it? No. volatility discussions, I should say. I must be staring right at it. Earnings discussions on volatility. Sorry about that. And in relation to his questions, the one I told him you might want to consider looking at implied volatility calculations on different criteria and percent IV range. And is it good to sell a covered call with a low implied volatility? Well, this is the other end of that double-edged sword. I like the premium. I like that higher return. Don't get me wrong. Naked yield on a cash secured put, higher percent return if assigned on a covered call position because of the higher IV. But that does mean that underlying security in those options are pointing to something that has a tendency to fluctuate more wildly. Not what I really want for a neutral bullish structure such as a cash secured naked put or covered call position. Whereas selling into too low of an implied volatility, say below 0.2 or below 0.15, for example, below 15% implied volatility, now I'm getting much smaller premium. My 1 month out options might only be a 0.4 or a 0.5% return that I could almost get on a weekly option with just a little bit more implied volatility. The stock's going to be more stable. It's not going to move. But again, now is it worth it to just churn 0.4, 0.5% every 20 to 30 days rather than getting 1.1, 1.4, 1.3 with that mid-range implied volatility? Oh, of course, you could shoot for the moon and go for the higher implied volatility. We're seeing that 3, 3.5, 3.7% return at the 0.8, 0.87, and 0.9 implied volatility as well. So the double-edged sword does work two ways. Is it worth it to sell into too low of an implied volatility for that more stability? No. Sometimes it's good to be slow. You know, the tortoise and the hare. Sometimes that's good. That's why we like the married puts, because it reduces volatility in the market. We can still generate income. We've got that locked-in insurance in place. All right, so Kenneth, that's my thoughts on a little bit deeper beyond what I showed you in those videos there in our playlist for implied volatility on YouTube, but as it relates to cash secured put and the covered call. Know what the average is across the market. Look maybe a little bit below that for a little bit more safety, but still always research and analyze the positions. Yes, higher IV means more bang for your buck, higher enriched premiums, higher potential return, but it carries with it that extra risk of the potential that you're looking at a more fluctuating stock and a more fluctuating security, or it's pointing to some event coming up in the near future that may cause the stock to swing wildly. And that might not be the type of security you want for a cash secured or naked put or a covered call position.